Results to be expected by the defensive investor. We have already defined the defensive investor is one interested chiefly in safety, plus freedom from bother. In general, what course should he follow, and what return can he expect under average normal conditions, if such conditions really exist? To answer these questions, we shall consider first what we wrote on the subject 7 years ago. Next, what significant changes have occurred since then in the underlying factors governing the investor's expectable return, and finally, what he should do and what he should expect under present day early 1972 conditions. What we said 6 years ago, we recommended that the investor divide his holding between high grade bonds and leading common stock, that the proportion held in bonds be never less than 25% or more than 75%, with the converse being necessarily true for the common stock component. That his simplest choice would be to maintain a 50-50 proportion between the two with adjustment to restore the quality when market development had distorted it by as much as, say, 5%. As an alternative policy, he might choose to reduce his common stock component to 25 if he felt that the market was dangerously high, and conversely to advance it toward the maximum of 75% if he felt that the decline in stock prices was making them increasingly attractive. In 1965, the investor could obtain about 4.5% on high-grade taxable bonds and 3.5% on good tax-free bonds. The dividend return in leading common stocks with the DGAI at 892 was only about 3.2%. This fact and other suggested caution, we implied that at normal level of the market, the investor should be able to obtain an initial dividend return of between 3.5 and 4.5 on his stock purchases, to which should be added a steady increase in underlying value and in the normal market price of a representative stock list of about the same amount, giving a return from dividends and appreciation combined of about 7.5% per year. The half and half division between bond and stock would yield about 6% before income tax. We added that the stock component should carry a fair degree of protection against the loss of purchasing power caused by large scale inflation. It should be pointed out that the above arithmetic indicated expectation of a much lower rate of advance in the stock market than had been realized between 1949 and 1964. The rate had averaged a good deal better than 10% for listed stock as a whole, and it was quite generally regarded as a sort of guarantee that similarly satisfactory result could be counted on in the future. Few people were willing to consider seriously the possibility that the high rate of advance in the past means that stock prices are now too high, and hence that the wonderful results in 1949 would imply not very good but bad results for the future. What has happened since 1964? The major change since 1964 has been the rise in the interest rates on first-grade bonds to record high levels, although there has since been a considerable recovery from the lowest prices of 1970. The obtainable return on good corporate issues is now about 7.5 and even more again 4.5 in 1964. In the meantime, the dividend return of DGAI type stocks had a fair advance also during the market decline of 1969 and 1970, but as we write, it is less than 3.5 against 3.2 at the end of the 1964. The change in going interest rates produced a maximum decline of about 38% in the market price and medium term, say 20-year bond during this period. There is a paradoxical aspect to this development. In 1964, we discussed at length the possibility that the price of stocks might be too too high and subject ultimately to a serious decline. But we do not consider specifically the possibility that the same might happen to the price of high-grade bonds. Neither did anyone else that we know of. We did warn, page 90, that a long-term bond may vary widely in price in response to change in interest rates. In the light of what has since happened, we think that this warning, with attendant examples, was insufficiently stressed. For the fact is that if the investor had given some in the DGIA and its closing price of 875 in 1964, he would have had a small profit thereon on later 1971. Even at the lowest level, 631 in 1970, his indicated loss would have been less than that shown on good long-term bonds. On the other hand, if he had confined his bond type investment to US saving bonds, short-term corporate issues, or saving accounts, he would have had no loss in market value of his principal during this period, and he would have enjoyed a higher income return than was offered by good stocks. It turned out, therefore, that the true cash equivalent proved to be better investments in 1964 than common stocks, in spite of the inflation experience that in theory would have favored stocks over cash. The decline in quoted principal value of good longer-term bonds was due to developments in the money market and abstruse area, which ordinarily does not have an important bearing on the investment policy of individuals. This is just another and endless series of experiences over time that have demonstrated that the future of security prices is never predictable. Almost always bonds have fluctuated much less than stock prices, and investors generally could buy good bonds of any maturity without having to worry about changes in the market value. There were a few expectations to this rule, and the period after 1964 proved to be one of them. We shall have more to say about change in bond prices in a later chapter. 3. Expectations and policy in late 1972 and early 1970, late 1971 and early 1972. Toward the end of 1971, it was possible to obtain 8% taxable interest on good medium-term corporate bonds and 5.7 tax-free on good state of municipal securities. In the short-term field, the investor could realize about 6% on U.S. government issues due to in 5 years. In the latter case, the buyer need not be concerned about a possible loss in market value, since he is sure of full repayment, including the 6% interest return and the end of a comparatively short holding period, the DGAI, and its recurrent price level of 900 in 1971 yields only 3.5%. Let us assume that now, in the past, the basic policy decision to be made is how to divide the fund between high-grade bonds, other so-called cash equivalents, and leading DGAI-type stocks. What course should the investor follow under present conditions if we have no strong reason to predict either a significant upward or significant downward movement for some time in the future? First, let us point out that there is no series of adverse change. The defensive investor should be able to count on the current 3.5 dividend return on his stocks and also on an average annual appreciation of about 4%. As we shall explain later, this appreciation is based essentially on the reinvestment by the various companies of a corresponding amount annually on the undistributed profits. On a before-tax basis, the combined return of his stocks would then average, say, 7.5%, somewhat less than his interest on high-grade bonds. On an after-tax basis, the average return on stocks would work out at some 5.3%. This would be about the same as is now obtainable on good tax-free medium-term bonds. These expectations are much less favorable for stock against bonds than they were in our 1964 analysis. That conclusion follows inevitably from the basic fact that bond yields have gone up much more than stock yields since 1964. We must never lose sight of the fact that the interest and principal payment on good bonds are much better protected and therefore more certain than the dividends and price appreciation on stocks. Consequently, we are forced to the conclusion that now, toward the end of the 1971, bond investment appears clearly preferable to stock investments. If we could be sure that this conclusion is right, we would have to advise the defensive investor to put all his money in bonds and none in common stocks until the current yield relationship changed significantly in favor of stocks. But of course, we cannot be certain that bonds will work out better than stock from today's level. The reader will immediately think of inflation factors as a potent reason on the other side. In the next chapter, we shall argue that our considerable experience with inflation in the United States during this century would not support the choice of stock against bonds at present differentials in yield. But there is always the possibility, though we consider it remote of an accelerated inflation, which in one way or another would have to make stock equities preferable to bonds payable in a fixed amount of dollars. There is the alternative possibility, which we also consider highly unlikely, that American business will become so profitable without stepped up inflation so to justify a large increase in common stock's value in the next few years. Finally, there is the more familiar possibility that we shall witness another great speculative rise in the stock market without a real justification in the underlying values. Any of this reason, and perhaps others we haven't thought of, might cause the investor to regret a 100% concentration in bonds even at the more favorable yield levels. Hence, after this, for a shortened discussion of the major considerations, we once again enunciate the same basic compromise policy for defensive investor, namely that at all times they have a significant part of their funds in bond type holding and a significant part also in equities. It is still true that they may choose between maintaining a simple 50-50 division between the two components or a ratio dependent on the judgment, varying between a minimum of 25% and a maximum of 75% of either. We shall give our more detailed view of these alternative policies in a later chapter. Since at present the overall return envisaged from common stocks are nearly the same as that from bonds, the presently expectable return, including growth of stock values for the investor, will change the little regardless of how he divides his funds between the two components. As calculated above, the aggregate return from both parts should be about 7.8% before taxes and 5.5% on a tax-free or estimated tax-paid basis. A return of this order is appreciably higher than that realized by the typical conservative investor over most of the long-term past. It may not seem attractive in relation to the 14% or so return shown by common stocks during the 20 years of the predominantly bull market after 1949. It should be remembered that between 1949 and 1969, the price of the DJI IA had advanced more from fivefold, while its earnings and dividends had about doubled. Hence, the greater part of the impressive market record for that period was based on a change in investor and speculator's attitude rather than in underlying corporate values. To that extent, it might well be called a bootstrap operation. In discussing the common stock portfolio of the defensive investor, we have spoken only of the leading issues of the type included in the 30 components of Dow Jones Industrial Average. We have done this for convenience and not to imply that there is 30 issues alone are suitable for purchase by him. Actually, there are many other companies of quality equal to or excelling the average of the Dow Jones list. These would include a host of public utilities which have separate Dow Jones average to represent, but the major point is that there is the defensive investors' overall results are not likely to be decisively different from our diversified or representative list from a list than from another, or more accurately, that neither he nor his advisors could predict with certainty whatever differences would ultimately develop. It is true that the art of skillful and shrewd investment is supposed to lie particularly in the selection of issues that will give better results than the general market. For reasons to be developed elsewhere, we are skeptical of the ability of defensive investors generally to get better than average results, which in fact would mean to beat their own overall performance. Our skepticism extends to the management of large funds by experts. Let us illustrate our point by an example that at first may seem to prove the opposite. Between December 1960 and December 1970, the DJIA advanced from 616 to 839, or 36%. But in the same period, the much larger Standard and Poor's weighted index of 500 stocks rose from 58.11 to 92.15 of 58%. Obviously, the second group had proved a better buy than the first, but who would have been so rash as to predict in the 1960s that what seemed like a miscellaneous assortment of all sorts of common stock would definitely outperform the aristocratic 30 tyrants of the Dow? All this proves, we insist, that only rare can one make dependable predictions about price changes, absolute or relative. We shall repeat here without apology, for the warning cannot be given too often, that the investor cannot hope for better average results buying new offerings or hot issues for any sort, meaning thereby those recommended for a quick profit. The contrary is almost certain to be true in the long run. The defensive investor must confine himself to the shares of important companies with a long record of profitable operation and in strong financial condition. Any security analyst worth his salt could make up such a list. Aggressive investor may buy other types of common stocks, but they should be on a definitely attractive basis as established by intelligent analysis. To conclude this section, let us mention briefly three supplementary concepts or practices for the defensive investor. The first is the purchase of the shares of well-established investment funds as an alternative to creating his own common stock portfolio. He might also utilize one of the common trust funds or commingled funds operated by trust companies and banks in many states, or, if his funds are substantial, use the service of a recognized investment counsel firm. This will give him professional administration of his investment program along standard lines. The third is the device of dollar cost averaging, which means simply that the practitioner invests in common stock the same number of dollars each month or each quarter. In this way, he buys more shares when the market is low than when it's high, and he is likely to end up with a satisfactory overall price for all his holdings. Strictly speaking, this method is an application of a broader approach known as formula investing. The latter was already alluded to in our suggestion that the investor may vary his holdings of common stocks between the 25% minimum and the 75% maximum in inverse relationship to the action of the market. These ideas have merit for the defensive investor, and they will be discussed more amply in later chapters.